Hello, it's Paul Scott here on Monday the 8th of June 2015. Just a few things to comment on today. Foxtons, I see here, has dropped 4.3% today, but look at the sharpness of the recent fall. It peaked here at around 285. Obviously this is the London estate agent. So dropped from 285 to 237. There was something in the press about them charging 600 and something pounds to a landlord to replace a light fitting. That reminded me of when I used to rent a flat in central London, and the landlords lived in the flat below, my landlords, and they used Foxtons, and they said they were absolutely dreadful. The landlords came to me and said, "Look, Paul, we're not getting your rent money through." And I got my bank statements out and showed it being paid to Foxtons, months and months and months of rent, which Foxtons just sat on and didn't pay across to the landlords. Now, it might have been an isolated problem, I don't know, but it's worth bearing in mind as scuttlebutt, I think. Another thing I picked up on, IG Index have increased the margin requirements on the Chinese indices considerably. They're now up to 5% margin on Chinese indices, which makes you wonder if they're heading for a crash. Chinese markets have more than doubled in the last year, I believe. It looks like a bubble to me, so I'm steering well clear of that. I was talking with friends also about the situation with Greece and the euro. I mean, it's obviously got to be sorted out at some point. I think a lot of people are keeping cash on the sidelines because they're so worried about it. I mean, my feelings are that it's now such a known issue that you might even see a relief rally when the whole thing eventually gets resolved. Although I did read something about derivatives and banks. I mean, it could apparently bring down some more banks when all these derivatives on Greek debt unwind. But I think the politicians and civil servants know what to do this time. They know that if a systemically important bank goes wobbly, you refinance it. So I think all of this is potential stress to the system. But I'm not selling any of my small cap shares as a result of it. It's a known issue. Anyway, let's look at some more stocks because I'm just rambling now. REDT, these are some of the microcaps I didn't cover in the main report. Final results today look quite good, actually. Now, this is the thing that lost one of their major customers recently, but despite that, they've managed to deliver a 25% rise in profit before tax to just over £1 million. I think that's pretty creditable. Cash balances are up as well. What's the market cap of that one? I did mention this one in my morning report a while back when it was about 10 or 12p. Yeah, it's now, look at that, 21p. So stock rank of 99. The only thing I would say is, on something as small as that, 9.8 million, I think the stock ranks need to be used with considerably more care, because microcaps are so vulnerable to particular individual contract wins or losses and so on, as in this case. 9.8 million market cap, forward P of 10, 2.75% dividend yield. That looks about right to me. I mean, very, very small companies like this really shouldn't be on PEs above about 10. Arguably, they should be sort of between 6 and 10, I think, on a cash neutral basis. That was that one. I won't go into any particular detail on it because it's too small to be bothered with, really. Right, Grafenia. This is another tiny company. This is they run the website printing.com. And there are two. There's Grafenia, which used to be called printing.com, I think it was called. There we are, Grafenia. Now that's got a very high stock rank as well, 97. But again, similar caution because of the very small size. 10 million market cap. Forward. Now the dividend yield here, 7.6%. This thing has chucked out big divvies. It's down 14% today, so the market doesn't like their results. It's chucked out big divvies for years, if you look down here. But they did rebase them. So you can see on the right, the chart that has popped up, the divvies have been stepped down twice over the last few years, but and look, the dividend cover really isn't very good at all now, only just covered by earnings. Although it's got net cash here, a minus figure on the net debt line obviously shows net cash. I like to see the trend of net cash or net debt. The last sort of 4 years, cash has been just dribbling down a bit. Let's have a quick look. I think the results weren't too bad. Turnover down 12%. EBITDA, forget that, because there'll be a lot of capex. Oh, they show the capex here. Negligible tax charge, which is strange. Profit before tax. Oh, it's actually up 13% there. Valued at £10 million. Probably looks fully priced to me, this one. They've struggled for a number of years, this one. Very competitive sector. I think they're flagging these two new things they're doing. Marquette. Ooh, look at that. Marquette space. Nettle. Stupid names. Anyway, this is the latest thing they're trying and they're constantly innovating new things, because the printing side of things is very competitive, which they refer to here in the outlook statement. Dutch market's likely to be increasingly competitive. Probably will continue to see revenue contract. So really, it's a bit of a bet on these two new innovations working, which, I don't know, they've tried things in the past that haven't really worked, so I'm not terribly interested in this company. There's another one I think called, I can't remember the name of it, but there's another company that runs printed.com that recently put out disappointing results as well. Right, what's next? Let's get rid of that. So no, I'm not going to bother looking any further into that one. What's this one? Now Falkland Island Holdings. This is a really interesting, bizarre even company, with about 4 different divisions. I think this is worth a look. Group turnover, this is what, for the year to 31st of March. Group turnover was, well, up a tad, 38.5 million. Decent profit margin there of about 10%. Pre-tax profit up 14%. They obviously have operations in the Falkland Islands. They own land and build houses and property over there. Some of the KPIs are hilarious. I've got to show you these. Where are they? Now, they also run the Portsmouth Harbour Ferry Company, which is the ferry you get from Gunwharf Quays across to Gosport. So whenever I go to see my friend Gosport Julie, I have to get the ferry with her, and it's extortionate, the price to just travel a couple of 100 yards over the water, basically. And it's a license to print money. They make about £1 million profit on 4 million turnover. Where are the KPIs? They're somewhere down here. I don't know if I'm going to have time to look at them, so we're 8 minutes in already. Review of operations. Yeah, here you go. So the Falkland Islands Company is well, that's nearly half of turnover, isn't it? Portsmouth Harbour Ferry Company is small turnover, but big profit relative to that. So this is where the profit comes from, 3.5 million. Momart, this seems to be an exhibitions venue in London, but that's down quite a bit in terms of profits. Let's have a quick skim down here. This is the breakdown of the Falklands stuff here. FIC, I think, is Falkland Island Company. So they have retail operations, 4x4. Oh, I think they sell 4x4 vehicles. You've obviously got the political risk, haven't you, with the Falklands if the RGs invade again. Here we are, KPIs from the Falklands Company. Number of rental properties, 40. Number of vehicles sold, 76. Number of houses sold, 16. And the catch of squid in thousands of tons. So is that right? They caught 364,000 tons of squid. Oh, and there were 50,000 cruise ship passengers. And you've got various other things there. Now this thing's it's worth a look, because it's got strong asset backing. Falkland Island Holdings, that's it. Not to be mixed up with the other Falklands company, the oil and gas thing, in which I think this company actually has some shares. Look, again, high stock rank, 32 million market cap. Now look at the price to tangible book. It's not a great deal over tangible book, so you've got nice asset backing here. And then if you look at the trend of profitability, there was that standout year in 2010, but it's consistently making about 3.5 million profit each year. I like consistency of earnings per share. Look, almost rock steady at sort of 21, 22p, which puts it on a PE of about 11.3 earnings forecast. When you've got solid asset backing, that's not bad actually. Now the dividend yield, this is the fly in the ointment. Look, they were paying lovely divvies year in, year out, but that's been knocked back now. Only 4p forecast for this year. There was something in the results saying that they're retaining funds for investment. Well, I don't like that. I think with this type of value investment, you want a decent yield. So, for that reason, I think the shares will be weak, and I'm not going to take it any further. These charts here look quite nice. But I want the divvies, and they're pulling the divvies, so I think that's a mistake. This type of company should pay dividends. Right, very quickly running out of time. Forbidden Technologies, they've got this AGM statement talking about strategy. I mean, this one, I don't think they've got a viable business model at the moment. If you look at their, the company's history, they do video editing software, cloud-based. It all sounds very sophisticated, but I don't think they've really got a workable revenue model. Look, the stock rank's only 14, 12 million market cap. The shares have come down, halved in the last year, and they were higher. But look at turnover. They've not managed to get to £1 million turnover in 6 years of trying. Quite a big loss in the last year, and I think the cash is running out. So I think this is one to be, well, it's not my cup of tea, but I wish them well. I hope they do make it work, but it doesn't seem to be doing so at the moment. Filtronic, there's another trading update from them today. This thing I think is in real trouble. It did a 2.1 million placing last November, but look at the drop in revenue. Full year audited revenue is 10.3 million. That's just one division. 7 million. So that's about 17.5 million turnover, down from whatever that works out at, 33 odd million turnover the year before. Only 0.7 million cash left. I think this thing's really in the last chance saloon. Again, I wish them well. I hope they manage to turn it around. They've done some deep cost cutting here. Closure of offices in California, reduction in headcount, and so on. This is the one where the CEO walked the plank not long ago, and the CFO has taken over. Too risky for me. I shall leave it there. Speak to you tomorrow. Bye.